Welcome to Talk Tickers. I'm your host, and today we are stripping away the noise of the daily news cycle to focus entirely on the signal. We are doing what you might call a forensic accounting of market cycles.
That's right. I mean, usually on this show, we're hyper-focused on the immediate. We're looking at this quarter's earnings beat, or next week's Fed meeting, or, why a specific CEO decided to sell stock on a Tuesday.
All important stuff.
Absolutely.
Yeah.
But today, the mission is different. We need to zoom out, way out. Because to understand the precipice we are standing on right now, specifically with this massive AI infrastructure build out, we have to understand the ground we've walked before.
Exactly. And I want to be clear right off the bat, this isn't a history lesson for the sake of nostalgia. We aren't here to, reminisce about the sound of a dial-up modem or how cool it was to rent a VHS tape.
Right.
This is a breakdown of capital cycles. We are looking at the mechanics of a boom and really the anatomy of a bust. Because right now, the market is echoing a very specific frequency from the past.
It really is. It is the comparison being drawn in every boardroom, every trading desk, and frankly, every dinner party where someone brings up their NVIDIA or their Microsoft games. We are seeing three specific things happening simultaneously.
Okay, lay them out.
First, massive capital expenditure. I mean, trillions of dollars being poured into infrastructure. Second, extreme market concentration in just a handful of companies. And third, a revolutionary technology, artificial intelligence, that promises to change the way the entire global economy functions.
Which sounds incredibly exciting. It sounds like a new industrial revolution until you realize we've heard this song before. The comparison, of course, is the late 1990s, the dot-com bubble.
The dot-com bubble.
And the question everyone is asking is, are we repeating it?
And the stakes couldn't be higher. Investors need to know. Are we in 1995 at the start of a massive sustainable boom where the internet creates entirely new economies? Or are we in 1999 staring over the edge of a cliff about to witness trillions of dollars in wealth just evaporate?
So here is the scope for this deep dive. We are going to dissect the mechanics of the dot-com boom and bust, specifically the years 1995 to 2002. We aren't just looking at stock prices. We are going to analyze the regulatory catalysts, the business models, and something called the infrastructure absorption theory.
Which is really a fancy economist way of asking what happens when you build too many roads and not enough cars are driving on them yet.
Precisely. We will also apply behavioral finance principles to understand why smart money, people with PhDs and decades of experience chase bubbles. It's a fascinating question.
It is.
And finally, we will take all that forensic data and overlay it on the current AI boom to see where the lines match up and, crucially, where they diverge.
It's a fascinating setup because history rarely repeats exactly, but the mechanics of human greed and fear, they are constant.
So let's unpack the macro mechanics of the dot-com bubble. Let's go back to 1995. I think there's a misconception that the bubble happened just because people suddenly loved computers. Like one day we all just decided to go online and the market reacted.
Yeah, that's a common simplification.
Yeah.
It definitely wasn't that organic. It was, you could almost say, engineered. There's a specific set of ingredients that cooked this up. You have to look at the technical catalyst first. The Netscape moment in August 1995.
Right.
Before Netscape, the internet was a command line. It was for academics, military types, and, serious hobbyists. It was not for the average person. Netscape gave it a face, a graphical user interface. The browser made the internet accessible.
That was the spark. I remember the Netscape IPO. It was a massive event. They priced it at $28 and it opened at $71. It was the moment Wall Street collectively realized, oh, this isn't a science project. This is a gold mine.
It sparked the initial frenzy, absolutely. But, and this is the part people often overlook, Netscape was just the match. The firewood, the real fuel for the fire, was stacked by the government. We have to talk about the Telecommunications Act of 1996.
Now, I know the Telecommunications Act of 1996 sounds like the most boring topic imaginable.
It does.
It sounds like C-SPAN filler, but you argue this was actually the primary engine of the bubble.
Absolutely, 100%. This is crucial to understand. Before 1996, the telecom market was largely a monopoly game. You had the baby bells. It was static, predictable, boring. The act deregulated the market with the specific goal of fostering competition. The government basically said, if you want to be a telecom company, go ahead, lay cable, dig up the streets, compete.
And that created what you call the infrastructure arms race.
Exactly. It created a whole new class of companies called CLECs, competitive local exchange carriers. Companies you might remember like Global Crossing, WorldCom, Level 3, they went on a debt finance spending spree. I mean, they raised billions and billions in the high-yield bond market to lay fiber optic cables across the oceans and under every major city.
And the absurdity was the redundancy, right? It wasn't just one company laying cable.
Oh, it was a total land grab. You had crews digging up the same street in New York or London 3 or 4 times to lay different cables for different companies, all competing for the same future customers they thought were coming.
It's like building 4 highways from LA to Vegas, right next to each other.
That's a perfect analogy. They were building toll roads right next to each other, assuming traffic would grow infinitely to fill them all, and the market was cheering them on.
So you have the tech spark with Netscape and the infrastructure boom with the Telecom Act. Then, in 1997, Washington throws gasoline on the fire with the Taxpayer Relief Act.
This is the financial accelerant, the rocket fuel. The Taxpayer Relief Act of 1997 lowered the top marginal capital gains tax from 28% down to 20%.
That is a massive cut, nearly a 30% reduction in the tax bill for your winning bets.
Think about it. If you are a trader or an investor, that completely changes your calculus. Suddenly, it is much more tax efficient to hold appreciating assets. It incentivized speculative investment. It directly fueled the day trading culture that exploded in the late 90s. It just made the risk-reward ratio of holding a volatile tech stock significantly more attractive.
And we can't forget the backdrop of the interest rate environment, the macro picture.
No, you can't. The mid-90s were a Goldilocks period. Rates were declining, capital was cheap and available, and you have to understand the physics of money. When capital is cheap, it has to go somewhere. It hunts for yield.
Sure.
If you can't get a return in a savings account or a treasury bond, you move out on the risk curve. You start looking at stocks, then tech stocks, then venture capital, and that's what happened. VC inflows just exploded.
So you have cheap money, lower taxes on gains, a government mandate to build infrastructure, and a cool new technology. That is the perfect storm.
The absolute perfect storm. And that cheap capital birthed a very specific and frankly, a very destructive business model. Get big fast.
I love this phrase because it encapsulates the madness. Get big fast. It sounds like a bodybuilding supplement, not a corporate strategy, but it became the gospel.
It was an ideology.
Yeah.
The central tenet was that in the new internet economy, the first mover takes everything. So unit economics were completely ignored, utterly thrown out the window. Companies were operating with negative gross margins.
Let's pause and explain that for the listeners who aren't accountants, because that sounds like jargon. But what does negative gross margin actually mean in practice?
It means you are selling a dollar bill for 80 cents.
Yeah.
For every single widget you sell, you lose money before you even pay your rent, your staff, or your electric bill. You buy something for $10 and sell it for $8. The strategy was purely to acquire eyeballs and mind share at any cost.
They were trying to make it up on volume, the old joke.
Essentially. The assumption was that if you captured the network effect, if everyone was on your site, monetization would naturally follow later. You would figure out how to make money after you owned the market.
So executives weren't judged on cash flow or profits.
No, being profitable was almost seen as a lack of ambition. It meant you weren't reinvesting enough in growth. Executives were judged on their burn rate. It became a bizarre badge of honor. We burned $10 million this quarter on marketing. We bought a Super Bowl ad.
That's an incredible inversion of business logic.
Completely. And it reminds me of the IPO machine. The investment banks were just fueling this feedback loop. In 1999, the average first-day return for an IPO was 71%.
71%.
In a day! Think about that. That is not investing. That is a lottery ticket where almost every ticket wins. It created a perverse incentive where going public became the product. The actual business selling pet food or books or whatever was secondary. The goal was the liquidity event, the IPO.
And because of that, because earnings didn't matter, traditional valuation metrics were just discarded. You couldn't use price to earnings or PE because there were no E. There were no earnings.
Right. So the market invented new metrics.
Yeah.
We stopped looking at profits and started looking at price to sales. Then when the sales weren't high enough, we moved to more abstract things. Eyeballs, stickiness, registered users, or site visits.
Anything that went up and to the right on a chart.
Anything. Exactly. And that complete valuation detachment reached its absolute peak in March of 2000. The NASDAQ composite hit 5,048. The NASDAQ 100 forward PE ratio reached roughly 60 times. But here is the statistic that really tells the story of the whole era.
Go on.
At the peak of the bubble, only about 14% of dot-com companies were profitable.
That is a staggering statistic. Let that sink in. 86% of the companies driving this historic frenzy were losing money every single day they operated.
It highlights the difference between a stock and a business. A stock is a piece of paper that trades on sentiment and stories. A business is an organism that needs to eat, it needs cash flow, and eventually gravity always kicks in.
Okay, let's move to part 2 and look at some case studies in exuberance. We need to talk about the good, the bad, and the ugly. And I think we have to start with the ugly, the poster child of the entire bust, Pets.com.
It's iconic for a reason. And the funny thing is, the concept wasn't terrible on its face. Online pet supplies, it's a huge industry. People love their dogs. I mean, today, Chewy is a multi-billion-dollar company doing exactly this.
So the idea was right, but the execution was?
The execution was suicidal. They were trying to disrupt a brick-and-mortar industry with a fatal flaw in their logistics. They had high-profile marketing. Everyone remembers the sock puppet.
A sock puppet, of course.
They had a Super Bowl ad. They spent a fortune on branding. But the economics of shipping were completely broken.
Because dog food is heavy and cheap. It's a terrible combination for e-commerce.
Precisely. You're shipping a 40-pound bag of kibble across the country. FedEx or UPS charges based on weight. So Pets.com was often paying more for shipping than the entire profit margin on the food itself. They were losing money on every single transaction.
But because they had the venture capital, they just kept scaling the losses.
They had this belief that if we just get bigger, we'll negotiate better shipping rates with FedEx. But they never got big enough to make the math work. They went public in early 2000, raised $82.5 million. The stock went from $11 to 19 cents. They liquidated in November of 2000. Their entire public life was 9 months.
9 months. It's the ultimate lesson that brand awareness does not equal a viable business model. You can be famous and bankrupt at the same time.
You absolutely can.
Now let's talk about the bad. And I say bad in hindsight because this was actually a great company, a fantastic company. Cisco Systems.
Cisco is, I think, the most important lesson for investors today, specifically for those looking at AI hardware companies like NVIDIA. In March of 2000, Cisco was the most valuable company in the world. Its market cap was around $575 billion.
Bigger than Microsoft. Bigger than General Electric at the time.
And for good reason. They were dominant. They made the routers and switches that powered the internet. If you were one of those CLECs laying fiber or a startup building a server room, you needed Cisco gear. They were the picks and shovels of the gold rush.
So they had real revenue, they had real profits. They weren't Pets.com. This was a blue chip company.
A profit machine.
Yeah.
They were printing money. But the valuation,
yeah,
that was the problem. At its peak, it was trading at nearly 200 times earnings.
Let's do the math on that for a second. 200 times earnings means if the company pays out 100% of its profit to you as a dividend and never grows another cent, it takes 200 years to earn your money back.
Right. I mean, to justify that price, Cisco didn't just need to keep growing. They needed to effectively capture the entire global GDP growth for the next decade. The market had priced Cisco for absolute perfection. They assumed that the telecom spending boom, that digging up the streets phase, would go on forever.
But as we discussed, the telecoms had overbuilt. They bit off more than they could chew.
They ran out of money. The high-yield bond market shut down. The CLECs started going bankrupt one after another. And so demand for routers and switches just evaporated overnight.
And Cisco stock?
It collapsed 80%. Now here's the key point for today. Cisco didn't go bankrupt. They survived. They remained profitable. They are still a massive, successful company today. But it took nearly 2 decades for the stock price to recover to its 2000 highs.
20 years. That is the danger of valuation. Even if you pick the winner, the company that actually builds the future, if you pay the wrong price, you can have dead money for 20 years.
Exactly. Valuation matters, even for great companies. It's the iron law of investing.
Okay, let's look at the volatile MicroStrategy, which is interesting because they are a huge name in the news again today for their Bitcoin strategy, but back then, it was a very different story.
A very different story. This is a classic example of hubris and accounting tricks. The stock went from about $20 to $333 in a year. Just a parabolic move.
Right.
Management was celebrating. They famously took all the employees on a Caribbean cruise. It was peak 90s excess.
Nothing signals a market top like a corporate cruise for the whole staff.
It's a pretty good tell. But the growth was being propped up by aggressive accounting. They were recognizing revenue too early on long-term software contracts. When the SEC caught on and forced them to restate their financials, the whole house of cards just fell.
And the market reaction was violent.
Immediate and violent. The stock fell 62% in a single day. It dropped to $140 and eventually went all the way down to $1. Just shows that when momentum is the only thing holding up a stock, any fundamental crack causes immediate capitulation. There is no floor because there is no fundamental support underneath it.
But we did have survivors. There were companies that made it through the fire, Amazon and eBay.
Right. Amazon's a really interesting case because they burned a lot of cash, famously. But Jeff Bezos spent it on infrastructure, on tangible assets. Warehouses, distribution networks, software. They had actual customers buying actual things. So they survived a 90% stock decline because the underlying business had real utility and hard assets.
It wasn't just a website.
It wasn't just a website. And eBay was even better. They were profitable early on because they were just a marketplace. A beautiful business model. They didn't hold inventory. They didn't have to ship heavy bags of dog food. They just took a fee when two people traded with each other.
Yeah.
Very high margins, very low capital intensity.
So the survivors had one of two things. Either hard assets and real customers, or a superior capital-light economic model.
Correct. They weren't just selling dollars for 80 cents and hoping for the best.
Okay, let's move to part 3, the burst. From 2000 to 2002, bubbles don't just pop on their own. Something usually pricks them.
It's rarely one single thing. It's almost always a confluence of factors that change the narrative. First, you had interest rates. The Federal Reserve, led by Alan Greenspan, raised rates several times in early 2000. They saw the froth, they saw the overheating economy, and they tried to cool it down.
Taking the punch bowl away, as the saying goes.
Exactly. And when rates go up, bonds become more attractive. If I can get a guaranteed 6% return on a government bond, why am I holding a risky tech stock with no earnings? The risk-free rate is the gravity of financial markets. When gravity increases, high-flying objects fall back to Earth.
Then you had the macro news. Japan officially entered a recession in March 2000. That triggered a global sell-off, and tech stocks get hit the hardest in a risk-off environment.
They do. And then there was the media narrative shift. This is so important. We have to talk about the Barron's article.
Burning Up, a famous piece.
Published on March 20, 2000. This piece of journalism was devastating. It was simple but brutal. It just did the math on the burn rates. It looked at the cash balance of these internet companies, looked at their monthly spending, and calculated their time to death.
It put a date on the funeral for each of these companies.
It did. It showed that many of these darlings were going to run out of cash in 3 months, 6 months, 9 months. It broke the psychological spell. It turned them from future giants into insolvent startups in the public eye almost overnight.
And then a very practical catalyst that I think is fascinating, tax day.
April 2000. This is the mechanical part. Investors had made massive paper profits in 1999. Their E-Trade accounts were up huge. But the IRS requires cash, not paper profits. So when tax season came around in April, they had to sell stocks to pay the capital gains taxes on the previous year's massive gains.
So you have a wave of forced selling hitting the market.
Exactly. And that selling drove prices down, which triggered margin calls for day traders, which forced more selling. It just accelerated the slide into a full-blown crash.
The fallout was just brutal.
I mean, the numbers are hard to fathom, depending on the estimates. Anywhere from $5 trillion to $8 trillion in market capitalization just vanished by 2002. The NASDAQ dropped 78% from its peak. It bottomed out in October of 2002.
And it took 15 years to get back to that 5,000 level. 15 years. That is a generation of lost returns if you bought at the top.
A whole generation. But we have to talk about the telecom implosion specifically. This is the most critical part for our AI comparison today. Billions and billions were spent laying fiber optic cable. By 2001, only 5% of that fiber was lit or in use. 95% was dark fiber, just glass in the ground doing nothing.
This caused a wave of massive bankruptcies. WorldCom, Global Crossing, the companies that built the roads went bust.
Completely wiped out. But, and this is the crucial point for the whole story, that dark fiber didn't disappear, It was still there.
Okay.
It was cheap infrastructure. Because the companies went bankrupt, the assets were sold for pennies on the dollar to new owners. And that cheap, abundant bandwidth is what allowed Web 2.0 to happen.
So Google, Facebook, YouTube, Netflix.
They could only exist because the cost of bandwidth had collapsed to nearly zero. They were built on the cheap ruins of the dot-com bust. The investors in WorldCom lost everything, but society gained the infrastructure for the next 20 years of innovation.
That leads us perfectly into part 4, behavioral finance. Why do smart people buy bubbles? We can look at the numbers and the regulations all day, but ultimately markets are made of people.
And people are not rational calculators. Robert Shiller's irrational exuberance is the core text here. He argues that the market isn't efficient, at least not in the short term. It's driven by feedback loops. Price increases, generate stories. This stock is going up, so it must be a good company. Those stories generate buyer enthusiasm, which drives prices even higher. It's a self-fulfilling prophecy until the money runs out.
And then you have basic herd behavior, FOMO, fear of missing out.
Institutional investors are just as susceptible as retail investors, maybe even more so. Think about it. If you are a fund manager and your benchmark, the S&P 500, is up 20% because of tech stocks, and you are sitting in cash or old economy value stocks, you are underperforming.
You look foolish.
You look foolish. You risk losing your clients. You risk losing your job. So the incentives are perfectly aligned to force you to participate in the bubble, even if you suspect it's a bubble.
So it's not about being right. It's about not being wrong by yourself.
Exactly. The famous Keynes line. It is better for reputation to fail conventionally than to succeed unconventionally. A fund manager would much rather crash with everyone else than sit on the sidelines and look stupid while everyone else parties.
But what about the smart money? The hedge funds, the arbitrageurs? Why didn't they short the bubble earlier? I mean, if it was so obvious that pets.com was worth zero, why not short it to zero?
This is a great question. It's what economists call the limits of arbitrage. Shiller and others point out that shorting is incredibly risky and difficult in practice. First, you have unlimited loss potential. If you short a stock at $100 and it goes to $300, you are wiped out.
The famous saying, the market can remain irrational longer than you can remain solvent.
Precisely. And in a mania, stocks become hard to borrow. You physically can't find the shares to short because everyone is holding onto them. Plus, many institutional funds have mandates that prevent them from shorting. They are long-only funds.
So all the negative voices are effectively shut out of the market.
They are excluded from the price discovery mechanism. The price ends up being set only by the optimists, the true believers.
It's like a jury where only the defense attorney is allowed to speak.
That's a great analogy. And finally, there's the confusion between risk perception and risk preference. Investors didn't suddenly become reckless gamblers in 1999. They just miscalculated the risk. They believed the new economy narrative so deeply that they thought these stocks were safer than they actually were. They thought they were buying the next generation of blue chips, not speculative lottery tickets.
Now, let's bring this all to the present day. Part 5, the AI boom versus the dot-com bubble. This is the forensic comparison. Let's start with the parallels, the arguments for why this is, in fact, a bubble.
The parallels are striking, and you can't ignore them. First, CapEx intensity. We are seeing a massive, massive infrastructure build-out. JP Morgan estimates a $5 trillion build for AI over the next few years. The hyperscalers Microsoft, Amazon, Google, Meta are spending around $400 billion annually. That number is just breathtaking.
It feels just like the fiber build-out. Build it and they will come. A huge bet on future demand.
It does. And that leads to the second parallel, the investment revenue mismatch. There was a report recently showing that the top tech companies invested roughly $560 billion over 2 years in AI infrastructure, but they generated only about $35 billion in incremental AI revenue.
That is a massive gap. $560 billion out, $35 billion in.
It absolutely echoes the dark fiber overbuild. We are building massive capacity data centers, GPUs, that isn't being fully monetized yet. We are making a huge assumption that the demand will catch up to this massive supply.
And the market concentration?
Very similar. The Magnificent Seven represent about 35% of the S&P 500. In 1999, it was Cisco, Intel, Microsoft, and Dell dominating the index. The market is incredibly top-heavy. If these few stocks stumble, the whole index goes down with them.
And the venture capital frenzy, is that happening again?
Oh, absolutely. AI startups captured about 50% of all global VC funding in 2025. Valuations are completely detached from current reality. You have companies like Anthropic trading at massive revenue multiples. I've seen numbers like 183 times revenue in some funding rounds. It's the get big fast mentality all over again.
And sentiment. What are the professionals saying?
Well, a recent Bank of America survey showed that 54% of fund managers believe AI is in a bubble. CEOs themselves are issuing warnings about peak AI hype. It feels frothy. People are nervous.
But, and this is a big but, there are major divergences, the real innovation arguments, the reasons why this time might actually be different.
This is the bull case, and it's a strong one. The biggest single difference is the profitability of the anchors. In 2000, the builders, the telcos, were debt-laden and fragile. The users, the dot-coms, were broke. Today, the builders are the hyperscalers. Microsoft, Google, Amazon, Meta, these are the most profitable, cash-rich companies in human history.
Right. Microsoft Azure is running at an $86 billion run rate. It's a cash printing machine.
Exactly. They can afford to burn cash on CapEx for years without going bankrupt. They aren't funding this build-out with junk bonds. They were funding it with free cash flow from their core businesses. That is a massive safety net that simply didn't exist in 2000.
And let's look at the valuation multiples. NVIDIA, the poster child, trades at roughly 47 times earnings. That is high, no doubt. But Cisco was at 200 times earnings.
It's a different stratosphere of valuation. The S&P 500's PE is around 23 times today versus 32 times in 2000. We aren't at the same level of broad market insanity. The stocks are expensive, but most of them have real substantial earnings to support them.
What about utility? Is anyone actually using this stuff?
Yes, that's another key difference. AI is already showing real productivity gains. You have coding assistants, customer service bots, drug discovery tools. We are seeing credible reports of 10 to 55% efficiency gains in specific white-collar tasks. The fiber in 2000 was 95% unutilized. The GPUs today are being used. The rails are hot. People are actually driving on this new road.
And the investor base. Is it different this time?
It is. 1999 was heavily fueled by retail day traders, the taxi driver giving you stock tips. The AI boom is largely being driven by institutional capital and corporate balance sheets. It's a different kind of money. It's generally stickier, more long-term oriented.
So we have a fascinating mix, stronger fundamentals in the core players, but very similar overbuilding dynamics in hype cycles. Which leads us to part sucks. Future scenarios. What happens next? Let's discuss the infrastructure absorption theory.
This is the historical pattern that seems to repeat with every major technological revolution. It follows this path. First, there's massive overbuilding, which is the boom. Then there's a crash or consolidation period. And finally, there's absorption, where society learns how to use the cheap new infrastructure, leading to real utility.
We saw it with railroads in the 1870s.
Absolutely.
Right.
People who financed the railroads went bankrupt, but the tracks connected the nation and lowered transport costs for everyone else for a century.
And telecom in the 2000s bankrupted WorldCom, but gave us the modern internet.
So for AI, we are looking at three plausible scenarios. Scenario A is what I call the correction. This seems like the most likely outcome. We see valuation compression. Maybe the hot AI stocks drop 30 to 50% as the market realizes revenue growth is lagging the CapEx spend.
A painful but necessary reset.
Exactly. Weaker startups get wiped out. We'll find the pets.com of AI. But the hyperscalers, with their strong balance sheets, just absorb the losses and keep going. The broader economic impact is limited because the banking system is much less leveraged than it was in 2000 or 2008.
Okay, what's scenario B?
Scenario B is the prolonged restructuring. This is the 7 to 15-year grind. Think about clean tech 1.0 or the early days of biotech. The technology works, it's real, but the timing for mass adoption and profitability is wrong. We enter a deep trough of disillusionment. Capital dries up for years. And in this scenario, the hardware, the GPUs, becomes commoditized, which destroys the margins for the chip makers.
That would be very painful for NVIDIA holders and the like. And finally, scenario C, the bear case.
Systemic risk. This is a nightmare scenario. If the Magnificent Seven continue to trade as a single monolith, a fundamental failure in AI monetization could drag the entire S&P 500 down in a major way. This becomes really dangerous if we see the emergence of circular financing.
Explain circular financing. What does that look like?
Imagine cloud company A invests $1 billion in a hot AI startup B. Startup B then takes that same $1 billion and pays it right back to cloud company A to buy cloud hosting and GPUs. So cloud company A gets to book that $1 billion as revenue.
So it looks like real growth.
It looks like incredible growth, but it's just their own money coming back to them in a circle. It's not real, sustainable end customer demand. If that unwinds, if startup B fails, that $1 billion of revenue for company A just vanishes instantly. That's how you get a systemic shock.
That is the nightmare scenario. Okay, we have covered a ton of ground. Before we wrap up, we have a segment we call The One Question. If you are an investor looking at an AI company today, a software provider, a hardware maker, what is the one question you absolutely need to ask?
The question is the infrastructure being built today generating cash flow from real paying end users, or is it funded by venture capital subsidies?
Why does that distinction matter so much?
Because in 2000, a lot of the revenue was fake. It was just dot-coms using their VC money to buy banner ads from other dot-coms. There's a closed loop. True sustainability only exists when the end customer, a real business or a real consumer, pays more for the service than the cost of the capital used to provide it. If the revenue is just recycled VC money, it's a ticking time bomb.
That is actionable advice. Look for the real customer paying a real price. So let's conclude with our main takeaways from this deep dive.
Takeaway number 1. History rhymes, but it rarely repeats exactly. The mechanics of the AI boom with profitable giants funding the build are fundamentally stronger than the dot-com boom, which was built on unprofitable startups and debt. But the overbuilding risk is identical. We are likely building capacity faster than we can use it, and that always ends in a correction of some kind.
Takeaway number 2.
Valuation is gravity. It is the one law you cannot escape in investing. Even a revolutionary company like Cisco can be a terrible investment for 2 decades if you buy it at the wrong price. NVIDIA and the other AI leaders face the law of large numbers. Their incredible growth has to slow down eventually. If you pay 50 times earnings for a company whose growth slows dramatically, you will get crushed.
And our final takeaway, takeaway 3.
Infrastructure booms usually bankrupt the initial investors, but benefit society in the long run. The real winner of the AI wars might be the company that buys the distressed data centers and GPUs for pennies on the dollar in 2028, not the one that's building them at a huge expense in 2026. In these cycles, the second owner often makes all the money.
That is a very sobering thought. Being early is often indistinguishable from being wrong if you run out of cash. And here is a final provocative thought for you, the listener, to mull over. We talked about how the cheap, dark fiber of the 2000s enabled the entire Web 2.0 revolution. So if we do have an AI crash or even just a major correction and the price of compute becomes incredibly cheap because of this massive oversupply, what impossible business models become possible in 2030? What is the Netflix or the Google of the AI era that can only exist when intelligence itself is virtually free?
That is the trillion-dollar question.
Thank you for listening to Talk Tickers. Check your exposure to concentration risk. We'll see you next time.